It's time for In the Money, Stock Market Action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everybody. Welcome to the show today on this glorious April 27th, 2014. Today's Sunday and just a little bit after noon. So first and foremost, I hope everyone had a great holiday weekend last weekend. We took the weekend off from the show as, again, a lot of people were just enjoying family time, and that's a good thing to do, absolutely. But just looking over the market definitely did not take a break. We saw lots of wild action out there. The market's going up and down and ultimately paying more profits if you knew how to handle the market. And again, just going back to January 2014 when we debuted this show, I just warned when we were at those all-time highs, be ready. We're going to see some downside. We're going to see some choppy action. And ultimately, we were able to make money on the downside and then the upside and then the downside and then the upside. And that's called swing trading. And swing trading is something that you all should be doing. All right, and again, it's not a hard thing to do. All you have to do is look at the charts and use logic. It's really a logic-type-based trading. And what you want to do in this situation to excel at swing trading is look at a chart, right, and decide first and foremost, is it extremely extended to the upside or downside? All right, once you evaluate that, that's the first thing you do, and you can look at the daily chart to determine this, and you can find a chart on any website, Yahoo Finance, Google Finance, any really website out there, even, E-Trade, Ameritrade, and all those brokers. But once you determine if it's extended one way or the other, you then want to begin to look for a key resistance level if you're extended to the upside or support level if you're extended to the downside. For instance, if stock XYZ, we're just using a hypothetical here, is extended to the downside dramatically and coming into a low that it has not seen in, let's say, 3 years, you inevitably should see a bounce off that low. And if you know just to buy right there, you're minimizing your risk and maximizing your reward. And that's all it is, folks. All it is just ignoring the hype from Wall Street, the media, all that nonsense. We know they're out there that are they're going to ultimately hurt you. And you want to just come in and use your logic and just look at the chart. And again, I'm simplifying it quite a bit, but I think that's where everyone who is new can start. And by doing that, you can improve your performance in the investment world. So that's just a brief overview of what we do at InTheMoneyStocks.com. My name, again, is Gareth Soloway. I am the Chief Market Strategist at InTheMoneyStocks.com. And my goal is to educate all the investors out there. If you have a small account, a large account, if it's just a retirement account, if it's a trading account, it doesn't matter. Everything I say is going to be the truth about Wall Street with no hype in there. And that's why, honestly, every episode, every show we've done here, I've given you an outline of where the markets will go, and it's happened. I mean, it literally has happened. Have I had a couple calls that didn't go my way? Sure. But about 75, 80% of all my calls went in the correct direction, including the market, which is the most important one if you're just putting yourself on the right side of the market. Okay, what I want to discuss today, folks, we have a lot. Number one, what is happening last week? All right, what happened with the markets? Initially, we saw some upside early in the week, and then towards the end of the week, things got very jittery, and we saw some sharp selling. All right, by the end of Friday, we saw the Dow down 141 points, NASDAQ down 72, S&P down 16. The NASDAQ, again, taking the biggest bath of all, losing 1.75%. All right, so this market right now is a really whipping market. You see these big down moves, then these bounce backs, and then these down moves. And again, how does an average investor deal with this type of market? And I said this on my short segments that I do every day here on 820 AM News Talk Radio. I do them around the 9 o'clock, give or take a little time in the morning before the market opens, and around the 8:55 time frame after 4:55 p.m. time frame after the market closes. And I just said, listen, there's two types of investors out there. There's the investor that literally has no clue about the market and doesn't want to have a clue about the market. I think that's a mistake personally, because your investment in your financial future is what you're looking to retire on. I mean, you're building your income stream for retirement. You want to have as much money as you can so you can live as long and as well as you can in retirement. So I'm a believer that you need to have control of that and you need to build it. But listen, there are some people out there that don't want to, in which case, okay, those people should be out of the market right now. All right, I said this since January. If you followed my advice, look at what the NASDAQ's done. Down 5% from those highs, 6% from those highs. It's been down even as much as 8 or 9% from those highs. If you were in the biotechs, all right, those are down 25%. If you were in Facebook, those are down 20+%. And if you were in Pandora, those are down 40+% almost. And again, this is the understanding of the market that you must keep in mind. There are certain areas that are bubbles, and those were the areas that the media was pumping to the max. And why you must stay away from that, honestly, if I could give advice to anyone out there, I would say turn off the media. Turn off the financial media. It will get you confused. It will get you hyped up on the wrong side of the trade. All right, now, if you're someone who can be very logical, then use the media to your advantage. That's what I do. I will literally have some of these, financial media outlets on, and when they're pumping something, what do? I go look at the chart, like look at the Pandora chart. All right, when the media was pumping this to the max, Pandora was literally trading around $40 a share. And what I'll do is I'll use it as a contrarian viewpoint. So I'll say, listen, there's so much pumping going on of Pandora. It's at its all-time highs, up literally hundreds of percentage points from the lows over the last year or so. Now, instead, I'm going to use that as a contrarian view, and I'm going to short Pandora. Or I'm going to short Facebook, or I'm going to short Twitter. And by the way, I still remember being on this very show and telling everyone that Twitter was going to collapse and talking about how the media was pumping it and it was at $70 to $75 a share. By the way, what's the current price of Twitter per Friday's close? $41.56. I mean, think about that. 40% drop approximately. Insane. All right, going to last week, let's first talk about what happened each day of last week. I want you guys to be versed. I want you guys to be the geniuses out there that understand the nuances, which are what will make up the market and each day's trading environment. Number one, let's go to Monday. Last Monday, following a 3-day holiday break, the markets were very quiet. Why? Well, anytime you have a holiday weekend, assuming no catastrophes happen over the weekend, we have what is called a hangover. What's a hangover? Well, we all know what a hangover is. We've probably all experienced it at one point in our life, and it's kind of the same thing. All right, the market is very quiet. It's very lethargic. And you have a lot of traders out there that make up a majority of the volume on Wall Street that had a long weekend with their family. Maybe they're even extending it a day so they're not back at their desks. Even if they come back, they ate a lot of food over the weekend. They're tired from seeing all the family. And they're just going to sit there and relax, take a break, take an extra long lunch, hang out with their buddies at the trading desk. And therefore, volume is almost always very light on the day following a 3-day weekend or a holiday. All right, now, what does volume that's light mean? Volume, anytime you know that volume is light, you should automatically assume neutral to upside action. Why? Well, if the Wall Streeters who have been selling this market, we call it distribution when the big boys are selling. If they're not selling, well, then who's left? Well, the little little mom and pops. And what are they doing? Well, they're buying the market. All right, that's just the mentality of the average investor. Average investor has money coming in. Oh, the markets are still near their highs. Buy the dip's been working. Let me put a little bit money in. Now, that's the light volume. They don't have a lot of money. Remember, the mom and pops generally, even if there's a million of them, they're still not going to have a lot of money compared to Goldman Sachs, JP Morgan. I mean, those guys have billions, hundreds of billions, trillions of dollars. So the light volume means the little investors putting in. Generally, you should assume neutral to upside action. So Monday was very light on the hangover, and the markets went neutral to upside. Tuesday, volume very light again. No economic news early last week to note. So again, there was no driving force behind the market. Light volume again, markets pushed up for the second day in a row. Now, this is where things get interesting because on Wednesday, we had the lightest volume of all. Now, you might say, well, there's no hangover now because you're midweek. So why is the volume so light? And the answer is very simple here. All right. Everyone had turned all their eyes collectively, including myself, including the traders at InTheMoneyStocks.com who are awesome. All right, we'd all turned our eyes to watch for Apple's earnings and Facebook earnings that were coming out after the bell on Wednesday. All right, so there was no sense in positioning, and no one wanted to really take a leap and position themselves, too much on one side of the market. Everyone was just sitting back and saying, listen, let's see what Apple and Facebook do, and from that point, we'll make our decision afterwards. Do we want to be in the market? Do we want to be out of the market? All right, therefore, zero trading. I mean, it was so light on Wednesday, you could have literally slept all day. You wouldn't have missed a single thing. Okay? Now comes the Facebook and Apple earnings. The market closes at 4 p.m. Eastern time. The rumble starts. And you get an announcement from Facebook first. And Facebook initially sells off a little bit. Earnings were good. Their revenue increasing dramatically on all their sales and all their pop-up with all their ads in the Facebook feed and so forth. And initially, investors were, all right, that's pretty good, but you know what? This market's a little sketchy so far, so let's sell them off a little bit. So Facebook's down initially $1 to $2, and just briefly initially here. Then comes Apple, and Apple blows out the numbers. All right, they beat on revenue. They beat on earnings. More iPhones sold than expected. More everything basically sold. In addition, they announced a new $30 billion buyback. In addition, they announced a 7-for-1 stock split. So not only is Apple buying back more shares, which means there's less shares out there, which means each share should be valued slightly more, because, again, Apple has a ton of cash out there, but now they're also going to make the stock cheaper. Even though it's going to still have the same value, they're going to reduce the price per share by doing the split to a point where the average investor is going to feel like they can go in and buy it. Now, remember, stock splits really don't change the value of the company. All right, Apple's still going to be a multi-$100 billion company. But what it does is it gives everyone that has one share 6 more shares. So now you have 7 total shares when all is said and done after the split takes place. It hasn't taken place yet. And the price of the stock is just reduced by that amount. So you'll have the same value, the same dollar amount in the stock, but now it just trades at a lower multiple, which again is something that companies do to entice the average investor, which, by the way, should be a warning sign, because more and more of these companies over the last couple of months have announced this. We saw Visa do it. Oh, it was MasterCard, actually, that did it, I believe. MasterCard did it recently. We've seen a lot of other companies come out and do it. And what they're doing, essentially, is they're saying, listen, our valuation is stretched. We know that. And they know that. And they know their growth isn't going that much more. I mean, why do you think Apple's buying back shares? Well, part of it is the money that they have. Obviously, they're making a lot of money. But a regular average company, which includes Apple, to be fair, you buy back shares because it will automatically increase your earnings. Without actually making more money, you'd have less shares out there in the open market. Therefore, when you make $1 per share, you have more earnings per share because there's less shares out there. All right. Again, think about this, right? So if you have 10 shares in a company, okay, and you buy back 5 of those shares, well, now you only have 5 total shares. So if you made a $1 profit with 10 shares, it's 10 cents per share of profit, right? If you only have 5 shares, now it's 20%. So you've just doubled your earnings without actually making a penny more in earnings, which, by the way, is another warning sign I don't like to see. And listen, with Apple, they have so much money. I agree putting some back, and investors like Icon, these activist investors are pushing them to do it. So I think they have to do it. But you've seen a lot of companies just do this. And the worst thing I think is to see companies doing it when their stock's at all-time highs. Now, Apple's not. So that's a little different case. I think Apple's kind of becoming an old-school stock. But ultimately, a lot of these companies have been buying back shares when their stocks are at all-time highs, and that's not good. I mean, the company should be able to analyze their stock price and say, listen, this is not the time to do it. You do it when your stock is cheap. Just like we invest. We want to buy a stock when it's cheap, not when it's expensive. But they're doing it because they know they're not growing, because they know there's not much growth out there in the economy, and they're not increasing revenues. They're not increasing earnings per share, so they have to artificially do it. It's just like in 2009, 10, 11, and 12, how did companies maintain their EPS, their earnings per share? Well, they cut jobs. And when you don't pay, let's say you cut 10,000 workers from the workforce, and now you're not paying each of those 50,000 salaries, well, guess what? That money goes to your bottom line. So there's a lot of things these companies are doing to artificially make growth look a lot better, and we've seen that here in Apple again doing a buyback. In any case, people loved the news from Apple. Apple soared 8%, okay? And this is the key that I want you to understand, because when Apple started to soar, Facebook started to catch a bid in sympathy. And now Facebook was up after hours. And this brought us into the after hours period where the markets were rallying. Oh, my goodness. This is great news. Apple's back has its footing. It's growing. The buyback, the split, all these positives out there. And then the market opens up the next day. And what a nice gap up it was. Markets opened strongly to the upside. I even thought we were going to have a pretty strong day in the markets. And you guys know that for me, I think the markets, even though you'll have bounces along the way and we're going to play them for profits, I still think that the overall market is generally going to head down. Just the nature of the beast right now. Fed is removing liquidity. Fed is pulling back on printing of money. Fed is essentially removing the needle out of the arm of the markets of drugs. But this is what's crazy, and this is what set the tone for Friday and why I knew going into Friday we were going to have a sell-off. All right, so markets open up, Immediately, 9:30, the bell rings on Wall Street. The markets opened sharply higher, and they sold hard. Went straight down. Within 30 minutes, we'd erased the whole gains, and we're negative on the day. All right, now what's going on there? Well, simple. Institutions selling into it. All right, the institutions are not dummies. They know the market's going to have trouble here. They know. I've been telling you since January they've been distributing shares, and distribution means they're selling into the small investor, and they're trying to get out. They've accumulated positions for years now. They've got a lot to sell, and they got to do it when they can. So when you get a strong gap up, these institutions said, thank you very much. We're going to use this to our advantage. Sell, 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 sell. And the stock market came right back in. Now, the early morning period is when they can sell the most because that's when the most volume is there. As soon as volume dries up, they have to step back. And they say, okay, well, we can't do this because if we continue to sell at this rate, we'll crash the market. And it was almost like that. In the first 30 minutes, you almost got the sense it was almost like a little bit of a mini crash. It didn't turn out to be that because the institution stepped back. And then what happens as they step back, the markets kind of float and shop and ultimately closed neutral to positive. We had a small update. I think NASDAQ was up 21 points. Dow was 100% flat on the day. But listen to this. The fact that on that good news, you could not get a better rally in the markets, that you could not get a strong move. I mean, that was great news from Apple. The market loved it. And the fact that you got a small up day, that was a negative. And every one of you that are listening, you should be able to read that and say, whoa, if they can't rally this market up strongly on that type of positivity, this market's headed lower. And sure enough, Friday, the market sold off. And again, we saw a nice sell-off across the board. Part of that was on worries about Russia and Ukraine, continued tensions, which we're going to talk about when we come back here after a little commercial break. But bottom line is, I'm going to talk next segment about the market, about the Russian conflict, what's going on there. Is it going to escalate? Will it hurt the markets? And ultimately, how you should trade it. And we're going to talk about the coming week. So on that note, folks, I'm going to bid you farewell just for a quick commercial break. And again, this is In the Money Stock Market Action on 820 AM News Talk Radio. And my name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Alrighty, we're back here, folks, and it's great to be with you on a Sunday to give you all the insight that you need to have to rock the markets this week. Now, just before we went on break, I was talking a little bit about the Russian issue there. Before we get into that, I just wanted to mention that also one of the key catalysts for selling on Friday was some poor earnings from Amazon and Visa, two very big companies. Amazon's been in bubble territories for a long time, and the company barely makes money, and it's trading at crazy valuation. So I'm not entirely surprised to see that coming back to earth. But Visa, to see that down 5% on earnings is a pretty big deal right there. So we'll continue to kind of watch and see how things play out. But right now, on Friday, per the close, the biggest worry out there was the Russian-Ukrainian situation. It seemed like it's slowly escalating. Over the weekend, I don't think there's been a ton of escalation on today's Sunday that I've seen, but I did see that yesterday on Saturday there was some encroachment on airspace by the Russians flying over the Ukrainian airspace. It seems like the Ukrainians are setting up a blockade around one of the key towns that's run by a lot of the separatists, the Russian separatists, and I think that ultimately, anytime you go into a weekend and there's a conflict like this going on, especially as it's escalating slightly, the markets are going to play on the side of caution, which is one of the reasons why I thought the markets were going to likely see some profit taking into the close, which they did. We saw actually a full day of selling. But think about it like this. All right, the markets are closed from Friday at 4 p.m. till Monday at 9:30 a.m. So if you're an investor, if you're a trader, if you're on Wall Street, do you really want to hold positions when you can't get out for that period of time when something like this could erupt into a much larger scale thing? And the answer is simple. I mean, you wouldn't. It's just common sense. I mean, being smart about your money. You just wouldn't put yourself in that position if you have the choice. So I think that's a good part of it. Why we saw that selling on Friday along with the earnings. And I think the fact that on Apple's earnings, we saw Apple, even though Apple had a great day on Thursday, it didn't help the markets. And I think that really shook investor confidence as well. So you have a big issue here where, you've had the small investor continuing to buy the dip, but as they're buying the dip, one thing that you're going to notice, they're going to get more skittish about buying the dip, which is going to actually be one of the catalysts for more downside. When you take away that initial buyer, that small buyer, and you only have institutions selling, it really does create a void of who's left to buy the market, because their confidence is, all right, well, I'm buying the market on the dips, but it's not making higher highs here. So wait a minute, is there something I'm missing here? And they're going to slowly realize it. Now, unfortunately, they're going to realize it too late. And I think many of them have. I mean, if you were buying biotechs when the media was pumping, I mean, just ludicrous. I mean, how do you buy the IBB up where it was, trading in the high 280s? Now it's near, 220-ish, give or take a little bit. But, I mean, this is the type of things that happen, and this is why you have to look at those charts. I mean, if you just follow the rules I laid out for swing trading at the start of this show, and I said, look at the chart just initially, just get your general sense of the chart. Bring up the chart, the daily chart of IBB, and just look at it. When it was trading in February at $275, let's say, I mean, were you really going to, just using that mentality of looking to see if it's too extended, would you have really thought about investing, just knowing what I just said earlier in this show? And the answer is no. There's no way you would have, because the stock literally was up in the last couple years from underneath 100. So you're talking about from underneath 100 in October of 2011 to 275 in February this year. I mean, just a couple years. So, I mean, you just got to use, in a weird way, it's common sense, but I understand why the average investor is confused, because if you listen to the media is pumping like crazy. The media is saying, oh, we just got some buying, there's so much money flowing in here. Oh, and the media is all bullish. They want you to watch this TV. I mean, that's their goal, is to get commercial breaks. But in any case, guys, I got to take a quick break. When we come back, we're going to take some questions. I have some questions that were sent in to me. And again, this is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And this is In the Money Stock Market Action on 820 AM News Talk Radio.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, everybody, as we get into the second half of the show today. Again, on this glorious Sunday, April 27th, 2014. Again, my name, Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. And don't forget, folks, if you want to go check us out, go to InTheMoneyStocks.com. Click on the Research Center. That's going to fit 99% of you guys as your regular investors or your swing traders, and take the 7-day free trial. All right, no obligation. You sign up for the 7-day free trial, cancel it before it ends, and you're good to go. You get a good sense of what we do. And just to give you an example, and this is something I want you to do, we launched our brand new website. It is a stellar website. And if you go underneath Free Market Action on the homepage, a drop-down will show up, and you can go down and click on Research Center Track Record. All right, and if you do that, you will get all the calls we bought in 2014 and have closed out thus far, and what our gains or losses were. And just to give you a sense, so far in 2014, net gain, that's taking all the gains of every stock we've had as a play and subtracting the winners from the losers, net gain, 176.57%. That's 176.57% gain. And by the way, we're only in mid to late April. That's January, February, March, and part of April. 176.57%. Now, we never, and I would recommend this to every single person out there, we never say you should invest all your money in every single play. That's too high risk. Because even if we're winning most of them, you never want to take the one loser and have it wipe out so much of your account. So what you do is we recommend just putting 10%. If you have $10,000, you put $1,000 in each play we give out. If you have $100,000, you put $10,000 in. Just 10%. This is called kind of spreading out your risk, and therefore you won't make necessarily as much, but you have to protect your downside. And I think that's the key there. Okay? So when you're looking at the In the Money Stocks website, think about this. Even though 176.57% is awesome, just assume you put just 10% in each one of those positions. You would be up almost 18% for the year. Now think about how the average person's doing this year. What's the average person? Down 2%, flat on the year if they're lucky. I mean, think about that. 18% approximately, just under 18% gain. And that's just putting 10% of the account in each position. Amazing. And again, listen, Nick and I, my partner at InTheMoneyStocks.com, we're not perfect. We're going to have losses along the way. It's just the nature of the beast. But our strategies, our PPT proprietary, that's what we call it, the PPT strategies, which just stands for price, pattern, and time. It's the 3 factors you need to find in a chart to find an 80% success rate trade. If you follow that, which we do, and we put out trades accordingly, you get basically an 80% success rate. And by the way, we're actually above that this year. It's been such a great year. I think we're batting about 90%. That means 9 out of every 10 plays we give out are winners. Now, mark my words, we're going to have a loser here and there throughout the year. It's just going to happen. But it is an amazing thing there. And I do encourage you to go check out the track record because I think that gives you the best. I mean, these are time-stamped. There's no nonsense here. Time-stamped track record. You can check on the hot charts and alerts. It's all time-stamped, recorded, and doesn't allow for any errors. So it is what it is, and it's a beautiful thing, and I encourage you to get in the swing trading game and start making money with us. All right. We're going to go quickly to a caller here. Craig from Hernando. How are you doing today? Great to talk to you again.
Hey, Gary, it's been a while. Hey, listen, I did some research on that CNTF. I got out of it, by the way.
Oh, good.
Advice, and fortunately, I did the research, and I noticed there's a trend with the stock on CNTF, so you guys might want to follow it.
Mm-hmm.
What they do is, now I don't know if the company's doing it, or I heard the Securities and Exchange Commission or NASDAQ is looking into it. It's either the company or the big boys are doing it. But about 3 weeks, or give or take, before the earnings come out, the stock gets pumped up.
Mm-hmm.
Okay, it's like they want to give it a little real estate so it doesn't go under $1 a share.
Yep.
And every time the earnings come out, they mis-earn. That's why it went down this last time. They get trounced because their earnings suck.
Absolutely.
I'm sorry to say that on a Sunday, but it's true. The stock is a disaster. And now let me ask you something. So here's the deal on this thing. 3 or so weeks before it comes out, they'll start pumping it up again.
Mm-hmm.
Okay. Then they keep that thing above $1, and then just if soon you know that earnings will come out, unload the darn thing just before the earnings come out.
Yeah, absolutely.
Because they're gonna blow it every time. They've done it every 3 quarters or every quarter.
Yeah, well, just a couple things on small caps in general. Small caps, there's a reason why they're small caps, right? It's because they just generally don't make money yet. So, I mean, it's hard for a company that's burning through cash and trying to create the next great product to always beat. So what happens there is what you're seeing is expectations. You know, the little investors who are investing in these small caps, and they're getting all excited. They're like, oh, man, maybe it can hit a home run this quarter. And that drives the price up, that buying. And then when reality strikes, that's when everyone says, oh, listen, bad quarter again. Let's get out and just dump it out. So
let me ask you something about a company, like for instance this one being this Chinese. Can their buddies, like the buddies of this company, can they go and pump the thing up, artificially pump it up, or will they? Can they? Is it possible they can get caught and get in trouble for it?
Well, it's a tricky one because I mean, being a Chinese stock, there's a lot of things they can do in China that technically wouldn't be allowed here in the U.S. I mean, we've seen a lot of fraudulent companies out of China over the last few years because, you know, people, there's just not as, you can't investigate quite as easily to go over China and just, you know, knock on doors and stuff like that. But what I would just say about that is that there are ways even U.S. companies that are small caps can promote their stock. You can actually pay companies to write research reports that are positive. So, I mean, you know, you just want to, that should be in their news feed though. So if you see a research report that says something like, oh, you know, this stock is worth $10 a share, make sure you look at the fine print because they should have to disclose that they were paid this much money to write that.
This is my opinion now from research, but that Seeking Alpha, okay? I noticed they go in there, they pump up a lot of these stocks, and it's like, who's writing this stuff? You know, somebody you never even heard of, and 99% of the time they're always wrong.
Yep, that's true. And Craig, I think that's a great point, and I think it goes to just the general thing that I always like to say, whether you're listening to the financial media or you're reading something online, always look at the chart, always kind of do your own investigations because it's everyone has an agenda, right? I mean, you know, it's just the nature of the world, and we have to, as an investor, as an average investor, we always have to remember that. In fact, I'd rather you always think that, and maybe at some point it's not true. Maybe there's one individual out there that it's not true, but it's better to err on the side of caution, right?
And you know, it's like being a detective. You know, you have to be like Sherlock Holmes to try to figure stuff, and that doesn't always guarantee you're going to be right either.
That's true. I mean,
I had Kudlow on yesterday. You know that Kudlow guy?
Yep. Mm-hmm.
Who was under investigation many years ago. He's come on McLaughlin Group.
Yep.
Well, he had a guy on there pumping. Oh no, this is the time to get in now. he's all bullish and everything's fine and dandy. I said to myself, I'm going to listen to Garrett. I said, usually when somebody starts telling everything's fine and dandy, it's a time to start selling.
Yeah, it's true. And that's the thing. I mean, I've made so much money investing off of just going the opposite of a lot of these talking heads on TV. I mean, it's amazing. When you hear all of them chiming in bullish, 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 it's usually the time to sell. It's scary that it's like that, isn't it?
Or the contrary, when they're all telling that it's doom and gloom, that's probably the time to be buying, right?
100%, absolutely.
I think doesn't what's the guy, Buffett? Doesn't he kind of work that way, or doesn't he care?
Yeah, I think Buffett's a tricky one because he's been actually used in the past to soothe the markets when panic comes in. I mean, I think that in 2009 he came out and did that investment in Goldman Sachs where it was a crazy deal. He was like guaranteed 10% return even if the stock didn't even perform. But he was used because the markets were in such dire straits that they actually went and begged him. They said, "Listen, we need you to come out here." Same thing happened with Jesse Livermore back in the 20s. He was asked by the government to actually cover his shorts to show, to not only help the market go up, but also just to show that support for valuations. But yeah, I mean, I think Buffett's a pure value guy, and he overly. I'm not a huge fan of his overall. I mean, I think if you look at especially his return over the last year, it's nothing spectacular. It really isn't.
No, it isn't. So. I'm glad I got you, Garrett. I just got in the door and I rushed the phone. I said, "Good, I got a few minutes to call Garrett." I was up in a little ways from here. I was doing something, and so I'm glad I called you.
Nice, yeah. Well, thanks for calling in, man. It's always great to hear from you.
All right, I'll keep in touch with you.
Take care. Thank you. So, yeah, I mean, that's a great point, guys, is just going back to the CNTF, one thing I'd like to make a point on small caps, and this is something that took me a long time to understand, and it's still, I still flounder every once in a while, but small caps, when the market is great like it was in 2013, there's so much money to be made. But the same small cap in a different market environment will have so much trouble making a move. It will have so much. I mean, you could have the best chart set up in the world, and I found this out, unfortunately the hard way and many times. And it could make sense on 100% of the levels, and it just won't do it. And that's probably because people are more risk adverse, right? Small caps, we all know they're risky. I mean, lately, what stocks have been performing in the market? Hewlett-Packard, IBM, until earnings, obviously, with IBM. But these are old school stocks where people are getting a dividend. They've performed. I mean, they've been around for 20 years, 10 years, whatever it may be, many times more than that with some of these companies. So they're always going to have people saying, "Listen, I just want to be safe. I'd rather be in a Hewlett-Packard." All right, now, believe it or not, I'm short Hewlett-Packard right now, so go figure, right? I mean, that's how I view it. I view it as everyone's in that right now, so I think it's due for a pullback, and I think I'm basically flat in the money slightly on the position. But in any case, it's something to keep in mind is that money will rotate out of the small caps, all right, dramatically when the markets start to get a little jittery. Because, again, small caps are the riskiest of all. I mean, that's where the money's going to have the most trouble. All right, so that's a good one. I'm going to have a couple questions coming in here. We have our website at inthemoneystocks.com, Traders Life. A little shout out to everyone on there that is rocking it and posting great information. I got a couple questions coming up here from Traders Life, so let's get into them. All right, looks like Sean on Traders Life, who's a member of ours, saying, Would you be a buyer of Amazon? If so, at what price and what pattern would you look for? So what I'm going to do here is I'm going to bring up Amazon's chart here. I wish you guys could see the chart, but maybe you can follow along. So Amazon, again, topped out on a Pierce of 400. A big move up into 400. I mean, it was just ridiculously valued at that point. Since then, it's fallen to 300. $100 drop down, 10% on Friday off of earnings. Now, if you zoom out, all right, so you want to zoom out so you can see back a couple of years because this is how you find support. I know it's hard for me to teach you guys over the air, but I'm just going to do my best to explain it so you can get a visual picture. So I'm zooming out literally to now where I see back into 2011, which is multiple years, almost 3 years ago. And what I'm looking for is major highs in that period a long time ago that haven't been hit yet. And what I look for ideally is highs where the stock went up. Let's say the stock went up into $250, just naming a random number. And remember, it topped out at 400. But $250, which is just below current price by about $50 or so. And I want to see multiple hits of that range where it couldn't break out for a long time. So it went up to 250, pulled back to 220. Went up to 250, pulled back to 230. Went up to 250, pulled back to 210. And then finally went up to 250 and broke out. That's what you're looking for. All right, because what is that telling you? It tells you that there was resistance there, and finally it broke through that level. And that means that when it comes back to that level, that's going to be a solidified level now of support. So it was resistance, and now it becomes support. And for instance, I'm just looking at the chart here, and I actually do see a couple. All right, so there's a good range. It's a little hard because it's a little bit of a range here, but the big level, here's the big level, guys. The big level is, let me get a quote on this, $249. So essentially it is right at that 250 level. 249, a huge level of support. So if you're looking at a longer term buy level on Amazon, and again, honestly, the way it's falling, I mean, it fell $35 on Friday, so what's to stop it from falling $50 in the next week or so, right? I mean, maybe it does. But that is the level. If it gets down to 249, you got the even number break of 250. You've got major support there, multiple pivot highs right in that range. That is your level on Amazon. So again, could there be some quick swing trades at higher levels? Sure, there could. And of course, I'll keep you guys updated who are in the Money Stocks members if we get a quick fire trade for $20 bounce quick here and there. But for the most part, for those of you listening that are looking for that strong level where you could probably pick it up for a month move, maybe a couple month move of 10-20%, maybe that's the level right there. Okay. Another question coming in here from, let's see, just bringing up the questions. Bear with me. Looks like the question coming in is from Joe. Joe at inthemoneystocks.com here. And the question is, how do you feel about the use of 3 times leveraged ETFs as a trading vehicle? Is there too much risk or too much risk to trade them? And this is a good question because a lot of average investors, this is very important. Average investors always look to make money as quick as possible. And this is what gets them in trouble. All right, you can make money if you know what you're doing, but just going with a triple ETF, remember, you're tripling your risk. Every average investor generally says, "Oh, look at this, it's great. This is I can the market's going to bounce here, the market's going to fall here, and I can make 3 times as much money by playing this triple ETF." And remember, equity traded funds, that's what an ETF is, and it basically mirrors an index like the IBB. The IBB mirrors the biotechs. So the IBB we shorted a while back, had a great fall. We even played it for a 10% bounce, made more money there. But that's what an ETF is. It tracks like a sector, an index, a market, something like that. You got commodities, you got currency ETFs, everything. So going back to triple ETFs, this is the tricky thing with triple ETFs. All right, while they can pay you 3 times as much, remember, there's 2 sides to every coin. You can lose 3 times as much. And if you're a new investor, if you're an investor that doesn't have a good footing, if your track record, for instance, and you look back and you didn't see 2007 coming, the top coming in the big collapse, which literally, 99% of people didn't see, then you want to be very careful here. Because if you're just off a little bit on that triple ETF, let's say you short the market using a triple ETF and the market goes up another 5%, that's a 15% cut into your profits. Remember, 3 times. So the market just going up 5%, which it could do in a week or two, can hurt you 15%. All right, and imagine if you, for instance, used a triple ETF in 2012. I mean, literally, you could be almost zero on that investment because of how much the markets went up in 2013. 30% move in the markets, that's a 90% loss in a triple ETF. All right, now that's not even the worst of it. So first of all, just the risk issue. And by the way, I had to learn these lessons the hard way too. When these ETFs first came out, they didn't really have many disclosures. They didn't really talk about it. And then the SEC came in and got really harsh on them and said, listen, you got to make sure, the right disclosures, people understand what these triple ETFs are. And honestly, most people still don't. But the other issue with the triple ETF is that they eventually all go to zero. Well, they never get to zero because it's always just a quarter penny away or a millimeter away. But it's just a little harder for me to understand or explain, excuse me. But, all right, take something, right? Take a $10 ETF. All right, the $10 ETF goes up 10%, goes to $11. All right, now have the same ETF drop by 10%. What price do you get? $9.90, right? Or right around there. All right, so if you keep on going up 10% and down 10%, up 10%, down 10%, up 10%, down 10%, what you're going to have is an ETF that loses a minuscule amount every time that happens. And do the math. Just take $10, multiply it by 10%, and then, take 10% away. Add 10%, take 10% away. Add 10% again, take 10% away. And you'll notice that price goes to $9.90, $9.80, $9.70, $9.50, whatever, all the way down. And that's the problem. So the NASDAQ or the S&P may just be going up and down 10% and right at that same level. But because the triple is exacerbated by a triple here, you're going to slowly get lower and lower. So what you'll notice with a lot of these triple ETFs, even double ETFs do this too, is they eventually slowly, over time, they get closer and closer to zero. And guess what the ETF does? Does a reverse split. So now they'll take the ETF, which is now $1, and they'll do a 50-for-1 reverse stock split. It'll go back to $50. And then it starts the path again and goes up, down, up, down, up, down, back and forth, slowly getting down. So this is how you trade them if you're going to trade them. Number one, you understand the risk involved. You're tripling your risk. Yes, you're tripling your reward, but remember, risk has to be the assessment here. That's the number one thing you need to look at before you look at reward. After that, what do? You have to understand that these things eventually all go to zero, which means they're short-term investment vehicles only. All right, I do play double ETFs, occasionally a triple ETF, but guess what? I'm in and out in a week. That's my goal. And you have to have a stop regardless. If the stock ETF drops on you 10%, 15%, whatever it may be, you got to cut it. But ultimately, only use them if it's a short-term trading vehicle and if you understand every nuance about it. And this is important because, for instance, the VXX, which tracks the VIX, right? Everyone thinks, oh, the VXX, which tracks, and by the way, we have the VIX right now, the VXX, as a long plate in themoneystocks.com, but everyone thinks, oh, it tracks the VIX, the volatility index. But it doesn't. The volatility index is the current month contract of the VIX. It's current. The VXX tracks the future contracts. So as time elapses, it can lose value because, again, the VXX is tracking future contracts down the line, 3 months out, 4 months out, 5 months out. And now remember, if you're an options person, you know that as time elapses, value is negated. And eventually they roll over to the next contract and so forth, but there's slippage there. So you got to understand these nuances. It's not so simple. My suggestion, if you're going to play ETFs, if you're short-term, doubles and triples, that's up to you. I leave that in your hands. If you're long-term, stick to the singles. Stick to an equity fund that tracks the S&P, long or short, one time. That's much safer to do. And always have a stop. All right, we're going to take a quick break here, guys. My name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. This is In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
All right, back for the final few minutes of the show today, and what we're going to do is we're going to go into next week's action and look at what to expect because there's a lot of things that are going to be happening. Last week was void of almost any economic news. Yeah, sure, you got jobless claims, you got oil inventories, you got like the small reports that don't have much meaning, but that is not the case this week. We're going to have some monster economic news that will shape the markets. All right, so number one, going into the week, watch the Russian-Ukrainian situation. That's number one. Next, what I want you to start to do, let me just bring up these economic reports. All right, we have some more earnings, but earnings for the most part are over. Later in the week, we'll have Chevron and Exxon reporting, which will be interesting for the energy sector. But Monday, pending home sales. All right, Tuesday, the Case-Shiller Index, which will also be a home price index report. Tuesday, consumer confidence. All right. On Tuesday, also, the beginnings of the Federal Reserve FOMC committee meeting will begin. It's a 2-day meeting. So that means on Wednesday, we will get word from the Federal Reserve on whether or not they're going to be cutting more quantitative easing. The expectation is another $10 billion out. So that's a big deal, folks, because remember, if things kind of get worse in Russia, Ukraine, if any sort of negativity starts to really envelop the markets, maybe they won't cut it. You know, I still think this meeting they will, but I could see in the future if things around the globe start to be destabilized a little bit more and the markets get a little more jittery, maybe the Federal Reserve pulls back or maybe they only cut $5 billion instead of $10 billion. But again, already Monday, home stuff, home sales, Tuesday, home price index, consumer confidence. Fed meeting begins Tuesday. On Wednesday, we hear about that. All right. Then on Wednesday, we also get a final reading on GDP. Now, GDP expectations are low, like literally around 1% or even 0. So expectations are low, which means if it comes in a little bit better than expected, maybe the market does inch up a little bit. I'm sure the Fed already has those numbers, so they'll probably base their decision on Wednesday off of that as well. I think the Fed gets these numbers, I'm sure, ahead of time from everyone else. But that alone seems like a big week, right? I mean, all this data, all these announcements, and that's just the beginning because on Friday, the non-farm payrolls number, and the unemployment report will be released. So this is just a humongous amount of data being pushed out this week, which should make for great trading if you're a day trader. And we day traded InTheMoneyStocks.com in the intraday stock chat. And if you're a swing trader, even better. The swing trading has been fantastic this year. The volatility is exactly what we make the most money off of, and we hope it continues. I don't even care if the markets stay in one place as long as they're going up 3%, down 3%. I mean, that enables us to make insane amounts of money swing trading. So that's what we have coming out next week. All right. Also, there are some stocks I want to touch on here. Number one, I think it's important to look at Yandex, YNDX. Why? Why Yandex? Sound weird name, right? This stock is actually the Google of Russia. And the stock had great earnings. The stock just a couple months ago was trading at $44 a share. It's now at $24. Why? Well, it wasn't the bad earnings because the earnings were pretty solid. So what was it? Well, it's the Russian conflict. And it's the chance that Putin's going to start to censor a lot of the internet. So this stock is getting pounded. And I almost wondered, on Friday it got as low as $21.70 before closing at $24. So, I mean, it already had a big bounce off the lows on Friday. But it makes me wonder if on Friday it did a little bit of an oversell and panic. And if things tomorrow, I mean, listen, it's a big risk. But if things kind of stabilize, this stock may bounce back a little bit. And it's something, this is one of those stocks where if ever you see a peace deal or some sort of negotiated settlement coming down the pipeline and things relax in that area, this stock would be a huge buy. I mean, literally, you could see 10, 20% into the stock in a matter of days. Probably in one day, 10% easy. So the symbol here is YNDX, and it's just put it on your watch list. I'm not saying to buy it necessarily now. It's a lot of risk involved because if things get worse there, this stock will continue lower. It almost filled a gap on Friday, which is somewhat interesting to me as well. But again, just on the basis, if you start to kind of get the sense that some deal is going to be worked out there, if tensions are going to de-escalate, then this is a stock you want to pay attention to. Another stock, and I put this one out, this is one of the ones I'm just going to talk about today that I put out to our Research Center members, and if you're a member there, you got this on Friday just before the close. And again, it was a buy on FEYE, which is a FireEye. It's a technology player. This stock was over $95, and that was, what date was this? Let me just take a look here. Wow, in March. In early March, this stock was over $95. It has since fallen to close at 41.15-ish, 41.18 on Friday. All right, I picked this up and gave it out to members because it filled a major gap fill. It is insanely short-term oversold. So again, I felt, I only did a small position. What I did is what I call a half position. But this was and could be a great bounce candidate if tensions are released a little bit this week and things calm down just a little bit. If we get some good news from the Fed, this could be a big bounce play. Now remember, I only did a half position. I'm going to buy the other half at double bottom if it gets below 40-ish, probably in the 35, 37 range. But in any case, guys, next week, be ready for volatility. Generally, my goal or my outlook is more negativity, more downside, but you're going to get big bounces along the way. So longer-term downside with short-term possible bounces. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. And it's always a pleasure to be with you. This is In the Money Stock Market Action on 820 AM News, and I will talk to you guys next week. Take care.